Hey there, I'm Ian Douglas. I'm the author of the website techinterview.guide, and I'm here to help people with career advancement and interview preparation. My live stream on Twitch covers topics such as company research, how to build resumes and cover letters, applying for the job, getting through interviews, and what to do during negotiations. I've coached thousands and thousands of people over the years to get jobs at the biggest tech companies in the industry, and I'm here to help you too. The following episode is taken from a longer live stream event and may contain interactions with other people in chat. Check out the end of the episode for more information. Let's get to it. So Heartbender asked in chat. Let me scroll back and find that in chat. It's here in chat somewhere. Where'd it go? There it is. Heartbender asked in chat, my company has a direct stock purchase program. What is it and should I do it? My advice to Heartbender is yes, you absolutely should. Because I know the company where Heartbender works. It is a very large international public company. They're based in the United States, but they do business around the world. It would be worth it to buy that stock. So with a big public company like this, that stock is generally it's going to, like the stock purchase program is generally going to be a discount program where you get to buy that stock at, say, a 5% discount or a 10% discount. What you want to do is you want to wait for the market to dip like it did today in a drastic way, and then like scoot in there and buy that stock, because then you get a discount on the closing price of whatever the price was the day that you buy them. So yeah, if you're eligible for this, Heartbender, I would suggest, yes, you should participate in that, because then when the stock market kind of bounces back for that particular industry, again, I'm not going to dox you and say where you work, but for that particular industry, which is going to pick up when the stock market recovers for sure, those stocks are going to be worth even more, and you're going to profit from that. And then when you turn around and sell it, you will pay tax on the profit. Now, the thing with the discount programs is when you buy the stock, depending on how much of a discount you get, and depending on what that discount is worth monetarily, let's say, like I haven't looked up your stock price, but let's say the stock is normally $100 and you get a 20% discount. So you buy the stock for $80. The IRS knows that it's worth $100. They know that you bought it for $80. So they may say, hey, that $20, you made profit, even though you haven't sold the stock yet, you've still made $20 profit. We would like our share. And you may be subject, maybe, to alternative minimum tax, or AMT, which is basically you prepay tax to the IRS on your eventual profit. That when you do turn around and sell the shares, and I'll make some recommendations based on my own experience in a moment. Standard disclosure, I'm not a tax accountant, I'm not a tax attorney, blah, blah, blah. Take this advice or leave it. I suggest leave it, but you're welcome to listen. What I would suggest is you may have to prepay some tax right away to the IRS. If you wait until next tax season, next April, you'll pay a penalty for waiting until next April to sort of prepay that profit tax, that AMT. But so you'll want to reach out to some sort of tax accountant or someone at the company that can help you with that. Although usually the company's going to be kind of standoffish, say, no, we don't get involved. You need to go find like your own tax person to help you navigate those waters. That person is also not me. So what I would do is reach out to somebody and say, hey, based on my current taxable income and tax bracket and so on, if I buy these shares at this price, when it's worth this much, like, should I prepay the AMT? Do you think I'd even have to pay the AMT? You may not, depending, again, it depends on that value. If that value is only a couple of bucks, the IRS may just say, nah, it's not worth it. And they may just wait for you to sell. Now, when you sell, whatever that price difference is from what you paid to what you sell it for, that's going to be profit. Like all of that is going to be profit. So again, if the stock is $100 and you buy it at 80, and then you sell it a year from now and it's worth 150, you've made $70 profit, and you're going to get taxed on that whole $70. Now, how much you get taxed on that profit is going to be based on when you bought the stock and when you sold the stock, because you're on a stock discount program, I'm presuming. You're going to have some sort of like stock purchase program where you're buying it at a discount. So it's not like you're granted shares. Typically in tech companies, you're going to have stock options, which is an option to buy shares in the company, or a reserve stock unit, which again, you're granted an amount of shares that you are allowed to buy if you choose, or they are just given to you, but you are granted those shares. Where the purchase program that you have, you are choosing to buy the shares. They have not allocated and they said Heartbender is going to get 1,000 shares at $100. They're not necessarily allocating that specifically for you. They're just saying, hey, if you ever want to buy shares, you get a discount of some amount, and then it's up to you. And so when it comes to tax time, you're not going to have to worry about the date it was granted. The only dates you're going to have to worry about is when you bought it and when you sold it. When you do a grant with an incentive stock option or an RSU, you have to tell the IRS when it was granted, when you bought it, and when you sold it. And when it was granted, if you buy it more than a year later and then sell it more than a year later, you get long-term capital gains, which is anywhere from 0 to 15 to 17%, somewhere in there. Like, it may not get taxed at all, or it gets taxed much less. If it was granted more recently and you bought it recently and then you sell it recently, like if all of those time spans are less than a year, less than a calendar year, I believe it's like a calendar year. Is it a calendar year or 12 months? I think it's 12 months, not a calendar year. So if you buy it in April, it doesn't like reset in December. It goes to the next April. So they're literally counting the months. If you've hung on to it for more than 1 year, if you hang on to it for less than a year and sell it, or it's been less than a year when it was granted and when you bought it, and then in less than a year when you sell it, you get taxed at short-term capital gains, which can be whatever your current tax rate is. In our tech industry, that can be anywhere from 30 to 40%. And so you end up paying a lot more tax if you turn around and sell it right away. Now, with your stock purchase program, because you're buying this like actual shares at a discount and you get to sell them whenever you want. You can like buy them one day and sell them tomorrow if you want. But if you don't hang on to them for that minimum of a year, I believe in the purchase discount program, I believe it's still that 1 year for the short-term capital gains, you're going to get taxed a lot heavier on it. And so I would say if you are going to participate in something like that, you really need to hang on to the shares for a long time. But talk to a tax person, a tax accountant, like someone who knows more about your individual situation and what those discount rates are. Have them look over everything. You can probably have to pay them for their time, but it may be worth it if you're going to save a bunch of taxes or make more profit based on their advice. So it could be worth the investment. RC Maniac says in chat, the way it was worded to me, if you get a $100 paycheck, you get 25% taxes on your income, leaving you with 75. If you have a stock purchase of 10% off the stock that was 10% a share, it's $9 for you, but it's still worth $10. So you can go spend $45 on stock, own $50 worth of stock. So not direct purchase stock, $75 take home. Purchasing stock is $91.24 take home. And the tax plus fee for selling the stock would still put you at more than $75 take home, aka stock purchase program is free money. It is effectively free money because they're giving you that discount. And so if if the share is worth $100, like I was saying, and you buy it at 80, you've already made $20 profit. You've already made $20, provided the stock stays there. If the stock tanks, you lose the money. The nice thing about losing, well, it's not nice to lose money on stock, but if you buy it at 80 and the stock dips less than 80 and you sell it anyway, the difference that you pay there is a capital gains loss. Or it's a capital loss, I guess. It's like a negative capital gain. And any money that you paid in tax ahead of time actually gets refunded. There's something in there where like you get some of that money back. Or it can like offset other taxes or something like that. Again, I'm not like a tax person. Just in my own experience, if you buy shares and you sell them at less than what you paid for them and you take a loss on it, it'll offset some of the other profit that you make if you buy and sell other shares too. So it can kind of balance out a little bit. Something to keep in mind. But yeah, definitely reach out to a tax accountant or someone that can help you for sure. And RC Maniac, I appreciate you offering some input on that as well. Thanks. Thanks for checking that out. I hope that you found it helpful. I always appreciate feedback, so please let me know what you think. I appreciate any subscriptions, so please tell your friends and colleagues about it as well. Check out the website techinterview.guide for more information about when I'm live streaming and all of my free content. Drop by a live stream anytime to ask questions or message me privately, whatever makes you most comfortable. See you next time.